I will be covering the next topic from the same chapter, that is chapter 10, financial markets. The topic is money markets. What a money market is? Money market is a market which deals with the short-term funds, and those funds, short-term funds, they are meant for a period of up to 1 year, right? So this particular market, it deals with the short-term funds which are meant for a period of up to 1 year, or you can say 365 days, right? Now, why a business firm? Why does a business firm requires money in a shorter period of time, or during a time of 1 year, right? So why does a firm requires money, right? A firm requires money generally for two purposes. The first one is for purchasing fixed capital assets, and that is required for the longer period of time, right? So a business firm requires money for two purposes. One is fixed capital needs, and the second one is the working capital needs. Fixed capital, as I told you in the previous lectures also, the fixed capital means the capital meant for purchasing plant, machinery, building, etc. And that capital is meant for the longer term, or that is called the longer term funds, right? Or the capital funds, right? Working capital is the capital which is easily convertible into cash, or that is generally meant for a shorter period of time, up to 1 year, right? In working capital, we have current assets and current liabilities. Current assets, for example, are debtors, are bills receivable, fine, and stock in trade, whereas current liabilities are creditors, are bills payable, fine, so they are the current liabilities. So for working capital needs, we require short-term funds. So you can say that in a way, this money markets, right, they satisfy the short-term needs of any firm, fine. And for fixed capital need, or the long-term funds, or the need for the long-term funds, it is satisfied by the capital market. Okay. Now let's come to the features of money market. What are the distinct features of money market? First one is, it is a market for short-term funds. We have just discussed that this particular market, it deals with the funds or the short-term funds which are generally meant for a period of up to 1 year. Fine. Now, why does a firm requires money in a shorter period of time? I raised the same question there as well. They require money for the shortage of cash. If any company, any firm is having any kind of shortage of cash, or for fulfilling the need of working capital. So for these two purposes, they require fund in a short term, and those needs, they are satisfied by the money market. Fine. Second is, no particular place of exchange or transactions. In money market, the transactions, they are generally done, or the activities are generally conducted through a phone, internet, fax. Fine. So there is no particular place of exchange or transaction. Third one is, the money market is highly liquid or volatile, you can say. Fine. Why it is highly liquid or volatile? That, as I told you, that it deals with shorter term funds which are easily convertible into cash. Fine. So this particular market, money market, deals with those money instruments which are easily convertible into cash. Fine. So that's why it is called highly volatile or liquid. Fine. DFHI provides ready market for it. Fine. So they are easily convertible into cash. The fourth one is, the money market, it is considered to be less risky. Now, why it is considered to be less risky? As I told you, that it deals with shorter term funds, fine, or the instruments of money markets are unsecured. They are unsecured, though they are less risky, right? They are unsecured, they are money market instruments, they are unsecured. However, nonetheless, they are less risky. Why they are less risky? They are less risky because of the shorter period of investment. They are less risky because the amount of the investor is not supposed to be blocked or parked for a longer period of time. As and when required, because of the high liquidity, the investment are easily convertible into cash. So that's why they are considered as less risky. Fifth one is the major participants. Now, who are the major participants in money markets? The first one is the RBI, Reserve Bank of India. Commercial banks, all commercial banks, they are the part of money market, or they are the players or the participants in the money market. Non-banking finance companies, non-banking finance company means they are the companies, but they are not banks, they finance, fine. They provide money to the people, but they are not banks. State government, large corporate houses, and the mutual fund agencies. We have different mutual funds, you might have heard about that we have Reliance, we have HDFC, we have Tata, so we have different mutual funds, right? So all mutual fund companies or the AMCs, they are also a part of money market, fine. Now, what money market instruments are? Money market instruments means instruments which we generally use in the money market to raise funds or to get money. They include the debt securities that are supposed to be redeemed within a very short period and there is no risk of default, right? So money market instruments are those instruments which we generally use to borrow money for a shorter period of time, and they are easily convertible into cash and has a very no risk of default, fine, means there is no risk of the loss of the money. Features of money market instruments. What are the basic features of money market instrument? The first one is they are highly liquid. Highly liquid, I just told you that they are highly liquid means they are easily convertible into cash, where as and when required you can convert them into cash. They are very close substitutes for money. If you are having any money market instrument with you, that depicts or that shows that you are having money in your hand because of the liquidity, that any time whenever you require you can just go and convert that instrument into money. So that's why it is next to cash. Third one is very low risk securities. They are very less risky, or you can say that they have a very low risk of default, fine, because they are not meant to be kept for a longer period of time. Fourth one is short term debt instruments. Short term debt instrument, I told you that such instruments, they are meant for very short period of time, for 365 days or up to 1 year, right? Now there are 5 main money market instruments: call money, treasury bills, trade bills, commercial paper, and certificate of deposit. The first one is the call money. Now these are the various features of call money. What call money is? It is also called as an interbank call money. This particular instrument is generally used by banks. For example, there are certain banks who are having the excess cash with them, and there are certain banks which have a shortage of cash. So the banks which have a shortage of cash, they generally borrow cash from the banks which have excess of cash, right? Banks which have excess of cash, they lend money to the banks which have shortage of cash, fine. So that's why it is called interbank call money. Second feature says that these transactions, the exchange of money between two banks, that is interbank call money, the transaction that generally takes place over the phone, fine. Third one is extremely short maturity period. It has a very very small short maturity period, that is of 1 to 15 days. Next feature says that it is used by banks to maintain the CRR. This call money is used by bank, I told you, why? To maintain the CRR. Now what CRR is? CRR is a cash reserve ratio, right? what happens that RBI, Reserve Bank of India, according to the guidelines of the Reserve Bank of India, all commercial banks, they are supposed to maintain a minimum cash balance with RBI. Fine. That is called the CRR, cash reserve ratio. And that CRR, RBI keeps changing that cash reserve ratio very often. Every now and then, RBI keeps changing that cash reserve ratio. So because of the change in the cash reserve ratio, it affects the availability of cash with the banks. Fine. It affects the availability of funds or the cash with the banks to give loan to the people. Fine. So to maintain the CRR, banks, they are supposed to deal with the call money, or they require the call money. Next is interest rate paid. The interest which is paid on the call money, that is called the call rate, and call rate is very volatile. That is very volatile. Volatile means keeps changing very often, frequently. Next one is demand for call money. There is an inverse relationship between the demand for call money and the call rate. If call rates, they are decreasing, so obviously that will give boost or rise to the demand for call money. It will increase the demand for the call money. Second money market instrument is treasury bills. What treasury bills are? These bills are the short-term borrowings issued by RBI on behalf of the Indian government, right? RBI issues these treasury bills. These treasury bills, they are negotiable money market instruments, and they are freely transferable and are easily sold to the banks or to the public, right? Next is, these treasury bills, they are issued at the price less than the face value, right? For example, the face value of treasury bills, if that is 1 lakh, right? So they will be issued at 90,000, right? They would be issued at 90,000, means the face value is 1 lakh rupees and the issue price, the price, they are issued at the price of 90,000. Fine. But at the time of maturity, these treasury bills, they are redeemed at par, means the value, the actual value of the treasury bill. So on maturity, these bills, they will be redeemed at par, that is for 1 lakh. The difference is 1 lakh minus 90 equals 10. So these 10,000 rupees, it would be the interest received by the person who has purchased these treasury bills. Fine. The next feature is they are very safe. Why they are very safe? Because RBI, they are issued by the RBI, and RBI has a very strong financial position, or you can say the soundness of RBI. So they are considered as very safe money market instrument, and at the same time they are highly liquid. Highly liquid, wherever the liquidity word is, it means they are easily convertible into cash. RBI has a very strong financial position, fine, and it is very sound. So that's why RBI is ready to buy these treasury bills at any given point of time. These treasury bills, they are also known as the zero coupon bonds, or you can say that these treasury bills, they are with zero interest bills. Fine. The next feature of the treasury bill is that they are issued in the form of a promissory note. Promissory note, a note in which we are promising to pay some amount, fine, which we have borrowed. So that particular period, that promissory note is generally drawn for a period of 14 to 364 days, and these treasury bills, they are available for a minimum amount of rupees 25,000 and the multiples thereof. Fine. So these are the distinct or the various features of treasury bills. The third money market instrument is the commercial bills or the trade bills. Fine. They are the commercial bills. Why? Because they are accepted by the commercial banks. That's why they are called as commercial bills. Fine. For example, these commercial bills or the trade bills, if two firms, if they are using these bills, for the purpose of credit purchase or sales of good, then you can say it is called a trade bill, means the bills which we use for the trading purpose, right? And if the same bill is used by any commercial bank, then it is called as commercial bills, right? So if we are talking about this bill as a trade bill, then how it works? For example, there is a business firm, first business firm, second business firm and the third business firm. Fine. So it is generally drawn by the first business firm to the second business firm and it is accepted by the third business firm. For example, if there is a firm which purchased goods on credit, which purchased, this particular firm, it purchased goods on credit from this particular firm. Fine. So this firm has to, or you can take like this. This firm has purchased goods from this particular firm. Fine. So it has to give 10k to this particular firm. Firm B has to give 10k to firm A. Fine. And firm A has bought goods of 10k from the firm C, right? So instead of paying cash to firm C, firm A will again withdraw a trade bill on the name of the firm B and it will be accepted by the firm C. Fine. So indirectly, this firm B is actually not paying to firm A, but it is paying to the firm C on behalf of firm A, right? So that's why it is called as trade bill, exchange of goods and services, or a bill of exchange which is being used for the exchange of credit purchase or for the sale of any kind of good. Fine. It is also known as the written acknowledgement of debt by the drawee. Fine. Who will make the payment after 90 days? Who will make the payment after 90 days? Means in the same example, this firm will make a promise that I will make the payment after 90 days for any kind of credit purchase. Fine. You can say these are the few features of commercial bills. It is issued for a period of 90 days. And again, likewise, treasury bills, they are also, commercial bills are also negotiable, freely negotiable, or free to get transfer or easily transferable to the public or to the banks. The fourth one is the commercial paper. What commercial papers are? It is an unsecured instrument, unsecured money market instrument which is issued by large and creditworthy companies. The companies which have a high net worth or which are creditworthy or have a very good financial positions, they issue such commercial papers, right? And they are the unsecured money market instruments. Or these this particular money market instrument or commercial papers, they are also called as an alternative to bank borrowings. For example, if bank is not lending you any kind of money, so you can just go to such companies and they provide you loan. Fine. These commercial papers, they are also called as negotiable instruments, that is freely transferable through the endorsement or delivery. Fine. The third feature says that these commercial papers, they are generally sold at discount and they are redeemed at par. Fine. They are also issued in denominations of 5 lakh or multiple thereof. The maturity period of such commercial papers, they are around 15 days to 1 year. They are used for the bridge financing. These commercial papers, they are used for the bridge financing. What bridge financing is? For example, a company has to raise long-term funds, right? Long-term funds through shares and debentures. So that will be used for the long-term finance. For issuing, when a company issues shares and debentures, there is a cost involved, right? And that particular cost is called the flotation cost. So to meet such cost, such flotation cost, a company raises money, right, through these commercial papers. Fine. And these commercial papers, they are issued in form of a promissory note. Fine. The fifth money market instrument, that is the certificate of deposit. What certificate of deposit is? It is a bearer document issued by commercial banks and development financial institutions. Means they are issued by any commercial bank or any financial institution against the deposit kept by company. If a company has to arrange the large amount or the cash, fine, the heavy cash, then the company will keep some deposit with a bank or any financial institution. Against that those banks or financial institution, they'll provide them or lend them money. Fine. And if a company has to arrange a large amount of money for a shorter period of time, fine, so then a company can opt for the certificate of deposit. So company will give a certificate of deposit. So this is called the bearer document, and they are freely negotiable. But banks are actually not permitted to discount or negotiate these certificate of deposits. Fine. The time period it ranges between 91 days to 1 year. So a company can arrange or take money from these banks or any financial institution by issuing with the help of certificate of deposit for 91 days to 1 year,